The Subcommittee on Housing and Insurance will come to order. Today's hearing is entitled Legislative Review of H.R. 5059, the State Insurance Regulation Preservation Act. Without objection, the Chair is authorized to declare a recess of the subcommittee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the Chair for inclusion in the record. Without objection, members of the full committee who are not members of this subcommittee may participate in today's hearing for the purpose of making an opening statement and questioning the witnesses. The Chair now recognizes himself for 2 minutes for an opening statement. I want to thank our witnesses for their participation in today's hearing. We'll introduce you all in a moment. We're here today to review the proper balance of the Federal Reserve's supervision of savings and loan holding companies primarily engaged in the business of insurance. Under Title I of Dodd-Frank Act, the Fed was given supervisory rulemaking authority over SLHCs in addition to its new authority to establish enhanced minimum leverage capital and risk-based capital requirements for insurers under that structure. So here's the situation we currently find ourselves in. If you are an insurance company that operates in multiple states, you are likely organized as an insurance holding company. That insurance holding company and its subsidiaries are regulated by state insurance commissioners. It's easy enough, right? The United States system of state-based insurance regulatory model has worked well for over 150 years. Let's say you are an insurance holding company and you own a thrift or a bank. Now you must register as an SLHC. One reason an insurer may want a thrift or a bank is to provide other services to their policyholders. Now keep in mind that the thrift or the bank also has its own regulator, the OCC. So these two types of entities within the SLHC are already regulated. As noted earlier under the Dodd-Frank Act, the Federal Reserve now has supervisory authority and access over every subsidiary in that SLHC, whether insurance or whether a bank. We are now in a system where a company primarily engaged in the business of insurance has 3 supervisors: the Fed, the insurance regulator, and the OCC. This is just for insurance companies with a thrift and or a bank. I want to note that Nationwide's testimony today that they are subject to very other regulatory bodies under their structure. That should be duly noted and highlighted. It seems to me we can have a better balance in regard to the Fed's supervision authority over an SLHCs primarily that are engaged in the business of insurance. I want to thank Mr. Rolfes for bringing this bill up and we're having a hearing today and a more broad discussion on what the proper regulatory structure should be. With that, my time has expired, and I recognize the ranking member, the gentleman from Missouri, Mr. Cleaver, for 3 minutes.
Thank you. Thank you, Mr. Chairman. Thank you for the hearing. Thank you for being here with us today. This bill before us today, H.R. 5059, introduced by Congress members Rothfuss and Beatty, would certainly would allow certain insurance, savings, and loan holding companies to be exempted from group-wide supervision by the Federal Reserve. Instead, they would be primarily supervised on the state level. Over the past few years, I, along with others on this subcommittee, have often expressed frustration about duplicative supervision and overburdensome compliance. Federal regulation in both the banking and insurance realm should be tailored appropriately. However, I do need to express my concern with 5059 as currently drafted, because I believe it could go too far in creating some kind of a loophole for large banks. And their goal would be, of course, to avoid any kind of federal oversight. Additionally, thrifts that are insured by the FDIC should be subject to adequate federal regulation. Though we're now nearing a decade, believe it or not, since the Great Recession, the lessons learned should remain on the forefront of our policy discussions. Following the 2008 financial crisis and the collapse of AIG, Congress determined that the Federal Reserve would have consolidated oversight of thrift holding and bank holding companies, including insurance, savings, and loan holding companies. The Fed now supervises insurance companies that have been designated as SIFIs, as well as insurance companies that own thrifts. Congress felt that it was important for the Federal Reserve to have the ability to assess the financial stability across all segments of large financial firms, including the parent companies and the subsidiaries. The goal is to prevent the kind of systematic failures that led to the economic meltdown of 2008. The Federal Reserve, though primarily a bank-centric regulator, has taken steps to understand the insurance sector. We know this because of its advance notice of proposed rulemaking for the capital framework for insurance companies under its purview. So I'm hopeful that the witnesses today will share their experiences working with the Fed on the insurance capital standards and elaborate on potential areas for improvement. As this bill has been recently introduced, I plan to use this hearing as a listening session. I'm only hoping today that the witnesses can provide enough information that it will expand our appreciation for this legislation. Thank you, Mr. Chairman.
The gentleman yields back. The chair now recognizes the vice chairman of this subcommittee, the gentleman from Florida, Mr. Ross, for 1 minute.
Thank you, Mr. Chairman, and thank you for holding today's hearing on this important proposal to improve oversight of the insurance industry by lifting costly and unnecessary regulations and providing our constituents with better financial opportunities at lower costs. Mr. Chairman, we talk a lot on this committee about unintended consequences, and that's no surprise given that our mandate covers one of the most complicated, interconnected marketplaces ever to exist, the U.S. financial system. Given this sprawling system, members of Congress are sometimes liable to say one thing, mean another, and ultimately affect a third, unintended and undesired result. That seems clearly to be the case here throughout Dodd-Frank. Congress repeatedly emphasized the primacy of state regulation in the insurance industry. The drafters took great pains to applaud and preserve the state-based system of regulation, which has served the American people well for decades. However, as the Dodd-Frank years have worn on, it's become increasingly clear that in some cases this Congress has failed to effect its stated intent and instead created laws that undermine the benefits and efficacy of our state-based regulatory regime. The story of insurance companies that operate or used to operate thrift holding subsidiaries is a good example of an unintended casualty of Dodd-Frank regulation. Today we will learn from witnesses who have watched firsthand as the promise of being left alone transformed into new and unprecedented regulations being placed on their businesses. I want to thank Congressman Rothfuss and Congresswoman Beatty for their working together on H.R. 5059 to help provide relief, and I yield back.
The gentleman yields back. The chair now recognizes the author of 5059, the gentleman from Pennsylvania, Mr. Rothfuss, for 2 minutes.
Thank you, Mr. Chairman. I want to thank you for calling today's hearing on the State Insurance Regulation Preservation Act, H.R. 5059. I also want to thank my colleague, Representative Joyce Beatty, for her hard work on this important issue. This is common sense, what I call right regulation. It's a right regulation bill that tailors the supervision of insurance-focused savings and loan holding companies. As many of you know, Dodd-Frank brought savings and loan holding companies under the Federal Reserve's supervision for the first time, despite the fact that Dodd-Frank also reaffirmed the state-based model of insurance regulation, a principle that many of us support. The law had the effect of also bringing insurance savings and loan holding companies under the Fed's purview. These are companies that are overwhelmingly engaged in the business of insurance, but also happen to own thrift subsidiaries. These insurance companies are simultaneously regulated by the Fed and the states. The lack of clarity regarding how Fed supervision of these insurers should complement rather than supplant state regulation has led to regulatory inefficiency, duplication of effort, and higher compliance costs. All of this cost and complexity eventually impacts consumers through higher prices and reduced access to services. We recently heard testimony from Rick Means, the president and CEO of Shelter Insurance Company. In Mr. Means' testimony, he described how Shelter was ultimately driven to close its small bank, since Fed supervisory requirements added more than $1 million to their compliance burden. We will hear a similar account today from Mr. Bach. Means wrote that, quote, expensive new federal supervision did nothing to protect consumers and instead worked to reduce competition and deprive consumers of banking options. Our bill addresses this issue by ensuring that insurance, savings, and loan holding companies that meet state and federal capital standards are supervised on a day-to-day basis by their state regulators. The Fed will serve as a backstop regulator, and it will be empowered to step in and take a more hands-on role if one of these companies does not satisfy its capital standards. Meanwhile, the Office of the Comptroller of the Currency will retain its authority over thrift subsidiaries. Again, this is a common sense, targeted, right regulation that will provide greater regulatory clarity and efficiency and reduce unnecessary compliance burden. Thanks, Chairman. I yield back.
The gentleman yields back. We now recognize our panel of 3 witnesses. Our first witness today is Mr. Michael Mohafi, Chief Strategist and Risk Officer for Nationwide Mutual Insurance Company. Welcome. Our third witness is back for, I believe, a second round, and one of our frequent presenters, Mr. Daniel Schwartz, professor at the University of Minnesota Law School. Welcome. And for the introduction of Mr. Block, Illinois native, I want to look to the gentleman from Illinois, Mr. Holkren, for that introduction.
Thanks, Chairman. It is a pleasure to welcome Kurt Bach, CEO of Country Financial. He's served as CEO for the last 6-7 years, oversees about 5,000 employees that they have there. They meet the needs, financial needs and insurance needs of almost 1 million customers. Also grateful for his service, served in our Air Force for 28 years, was Colonel, I believe. Is that correct? So Colonel Bach now is CEO of Country. He also is chairman of the Property Casualty Insurance Association Board of Governors. So grateful for his work there, and also was appointed back in November of 2015 to the Federal Advisory Committee on Insurance by the Director of the Federal Insurance Office. So Illinois has some challenges. One thing we do well in Illinois is insurance, and so I am so grateful for Country and other companies that are in Illinois as well, but we just want to welcome Mr. Bach, Colonel Bach, being here with us today. And thank you, Chairman. I yield back.
Illinois challenges, including football. All right, our witnesses in a moment will now be recognized for 5 minutes to give an oral presentation of their written testimony. Now, without objection, the witnesses' written statements will be made part of the record following their oral remarks. Once the witnesses have finished presenting their testimony, each member of the subcommittee will have 5 minutes within which to ask the panel questions. On your table, you'll note there are 3 lights. The green means you are a go. The yellow light means that you have 1 minute remaining, and if the light turns red, that would mean that the time is up. The microphones are sensitive, so please make sure you are speaking directly into them. And with that, we will now recognize Mr. Mohafi for 5 minutes.
Thank you. Chairman Duffy, Ranking Member Cleaver, and members of the subcommittee, thank you for the opportunity to appear before you today. My name is Michael Mohafi, and I am the Chief Strategy and Risk Officer for Nationwide Mutual Insurance Company. I'm testifying on behalf of Nationwide, but also represent a diverse group of insurers that, like Nationwide, are subject to both state insurance holding company supervision and Federal Reserve holding company supervision due to their ownership of a thrift. I am here today to testify in support of H.R. 5059 and would like to thank the bill's sponsors, Congressman Rothfuss and Congresswoman Beatty. As Nationwide's Chief Strategy and Risk Officer, I am responsible for our business strategy and enterprise risk management program. In these capacities, I have had the opportunity to engage directly with the Ohio Department of Insurance and with the Federal Reserve examination teams on numerous occasions. Therefore, I believe I can offer a helpful perspective on the inefficiencies in the supervisory environment faced by Nationwide and other insurance SLHCs, and how H.R. 5059 can maximize supervisory efficiency while avoiding gaps in supervision. Nationwide is an A+ rated diversified financial services company offering property and casualty insurance, financial services, and banking products and services. We are highly regulated across all aspects of our business. Nationwide is registered as an insurance holding company system in the various states where it is domiciled insurance companies, with the Ohio Department of Insurance serving as the lead state supervisor of the holding company system. By virtue of its ownership of Nationwide Bank, a thrift institution representing less than 3% of Nationwide's total assets, Nationwide is also registered as an SLHC and subject to an additional layer of holding company supervision by the Federal Reserve. We support appropriate levels of supervision and regulation. We are not seeking to eliminate the role of the Federal Reserve in ensuring our safety and soundness. Rather, we seek to ensure that our supervisory regime, 1, provides an appropriate balance between the roles of the Federal Reserve and the state insurance supervisors, 2, is proportional and tailored to the risk faced by our organization, and 3, allows us to focus on the risks that are most material to our organization given our business composition. We believe that H.R. 5059 achieves these goals. Despite significant supervisory and regulatory costs, Nationwide purposefully opted to continue to offer competitively priced, reliable banking products. These products and services create additional value for the members we serve. As an example, Nationwide Bank has created innovative solutions to deliver immediate access to insurance funds for our members in the wake of natural catastrophes, whether utilizing the prepaid claims cards in the aftermath of the Joplin tornadoes or supplying emergency debit cards to customers in Northern California wildfires who had literally lost everything. These solutions provide access to critical funds precisely when they are needed most. In the 7 years that we have been subject to Federal Reserve supervision, we have found Federal Reserve examiners to be dedicated public servants who consistently strive to work collaboratively and thoughtfully with us. We also appreciate the insurance policy team, led by Tom Sullivan at the Federal Reserve Board in Washington, which has provided invaluable expertise on insurance and has been equally open and collaborative in working with us. However, despite the sincere efforts of these professionals at the Federal Reserve, our current supervisory environment remains unnecessarily inefficient in ways that Congress did not intend. As my written testimony highlights in greater detail, there are several examples of instances where Federal Reserve Holding Company supervision has produced unintentional inefficiencies and redundancy vis-a-vis state supervision. These include overlapping statutory responsibility to examine the operating and financial conditions of the group, duplicative examinations, inconsistent supervisory regimes or regulatory standards, overlapping authority to require corrective actions, to name a few. Due to the intensive nature of Federal Reserve supervision, Nationwide's Board of Directors and senior management spend a substantial amount of time and resources reviewing, analyzing, and implementing Federal Reserve supervisory guidance that was designed by bank regulators for banks to manage bank-centric risks. Further, we devote a substantial amount of time and resources responding to examinations and information requests related to bank-centric supervisory guidance. These resources would be more appropriately devoted to our most material and relevant insurance risks, which are directly within the purview of the state insurance departments. I'd like to now turn to our support for H.R. 5059 and the appropriateness of this legislative solution. We do not believe that in passing Dodd-Frank, Congress intended to force insurance companies to sell their thrifts. We also do not believe that Dodd-Frank intended for the Federal Reserve to place the same supervisory demands on a $230 billion insurance company with a $7 billion thrift, which is already subject to extensive state insurance holding company supervision, as on a $230 billion bank holding company predominantly engaged in banking and other financial activities. We greatly appreciate Congress's longstanding commitment to the state system of insurance regulation and the thoughtful bipartisan approach this body has taken on the issues in the past, including the passage of the 2014 Insurance Capital Standards Clarification Act. H.R. 5059 would work in concert with that act by, one, allowing the Federal Reserve to monitor solvency at the insurance SLHCs by imposing capital standards, two, preserving the Federal Reserve's ability to examine material non-regulated entities and to monitor and address those risks through its relationships with primary prudential regulators of those insurance holding companies, and three, provide the Federal Reserve the ability to step in if reasonably necessary using its emergency authority. Mr. Chairman, in closing, I would like to add that it is critically important to Nationwide, and I know to all members of this subcommittee, that the legislation address regulatory inefficiencies without creating any regulatory gaps or inequities. We believe that a bipartisan solution to this issue is critical, and while we support the legislation in its current form, we also support necessary changes to improve the bill and increase its bipartisan support. We look forward to providing additional input as the process unfolds, and we greatly appreciate the opportunity to testify today.
Thank you, Mr. Mojavi. Mr. Bach, you are now recognized for 5 minutes for your oral presentation.
Thank you. Mr. Chairman, Ranking Member, and members of the subcommittee, my name is Kurt Bach, the Chief Executive Officer of Country Financial. I appreciate the opportunity to testify on behalf of the Property Casualty Insurers Association of America, which represents 1,000 insurers and reinsurers providing insurance products to families, communities, businesses around the world. Country is a mid-sized financial company from America's heartland that was formed by a group of farmers in 1925 and provides home, auto, business, and life insurance, as well as retirement, investments, and education funding for our customers. Country Financial has always been an AM Best rating of A+ or superior. Most importantly, our top priority is always our customers, and we assess any regulatory changes or proposals through their lens. State-based insurance regulation of Country effectively oversees all aspects of our insurance operations. To support our customers' needs for trust services and investment management, Country maintains a very small thrift. After the Dodd-Frank Act, the Federal Reserve Board assumed supervision of our entire insurance holding company based on our very small depository institution that accounted for only 0.2% of Country's total assets and had no transactional deposits or loans. While the Federal Reserve staff were exceptionally professional, the endless discovery questionnaires and on-site visits to oversee every corner of our operations consumed roughly 25% of our risk management, internal audit, and compliance staff time. Country had to engage both inside and outside counsel in responding to requests for information that added layers and layers of documentation and reporting beyond our current SEC, FINRA, OCC, and state regulatory requirements. The additional layers of regulatory oversight threatened to significantly distract from serving our customers, even though there were no material changes that were required or made as a result of what was an enormous amount of red tape with no real rationale or benefit to our customers or the broader company. We requested deregistration of our savings and loan holding company in 2015 and were released from Federal Reserve supervision in 2017. Even though country is no longer subject to Federal Reserve Board oversight, we hope that sharing our experience will help Congress right-size federal involvement in insurance. Numerous PCI members have had to divest their small depository institutions that were serving customers and adding synergies to their operations because of increased supervisory cost. Quite simply, the juice was not worth the squeeze, and that clearly was not the intent of Dodd-Frank. Does Congress really want the Federal Reserve to allocate their resources duplicating state oversight of Main Street insurance companies, particularly when the track record of insurance solvency in the last several financial crises compares very favorably with federal oversight? Last year, consumers suffered perhaps the worst insured loss year in U.S. history, including record hurricanes, wildfires, earthquakes, and tornadoes. But the insurance industry rose to the challenge. Customer satisfaction with homeowners insurers has never been higher, and the industry's financial strength is similarly at record highs. As insurers, we faced our 1-in-100-year crisis, and our company's and regulatory system emerged with record consumer satisfaction and solvency. We fully respect the integrity of the Federal Reserve in carrying out its new responsibilities, but we do not believe Congress truly intended to create an additional layer of intensive federal insurance supervision. After years of assurances that federal oversight will be proportional, it is clear that further legislative direction is required. The legislation by Representatives Rothfuss and Beatty clarifies the congressional intent of Dodd-Frank and the growing recognition that Federal Reserve oversight of insurance holding companies needs to be coordinated with state insurance regulators and appropriately tailored and limited to the Fed's unique mission. Just as country decided that the excessive resource costs of federal oversight did not support our core mission of serving our customers, Congress might recognize that requiring the Fed to be a duplicative regulator for insurers does not well serve its core mission. H.R. 5059 would go far in eliminating this unproductive duplication and would assure robust and coordinated state and federal regulation that is both effective and efficient. Accordingly, PCI and country look forward to working with policymakers to finalize and enact H.R. 5059. I thank you for the opportunity to testify today.
Thank you, Mr. Bach. The chair now recognizes Professor Schwartz for 5 minutes.
Thank you very much, Chairman Duffy, Ranking Member Cleaver, and members of the subcommittee. I'm very sympathetic to the goals of this bill, which are indeed to reduce regulatory compliance burdens on various firms that are already well regulated by the states. But I also have a number of substantial concerns about this bill that I want to air in my brief oral testimony today and that I also go into at some length in my written testimony. The first point I want to make in my oral testimony is that the bill actually goes way further than many of the statements that have been made today. And that's because of how it's drafted. The bill creates a new type of financial institution that hasn't been recognized before in regulatory and statutory language, and that's an insurance savings and loans holding company. It then subjects that company to reduced regulation compared to other savings and loans holding companies. This inevitably creates the risk of regulatory arbitrage, or as one of you mentioned earlier, unintended consequences. And I want to give you an example of that right now to start off my testimony. Under the bill's language, any bank that wants to avoid federal scrutiny could simply make its top-tier holding company an insurance company, get a license for that company to write insurance. Once it did so, under the bill's definition, it would be classified as an insurance savings and loan holding company because its top tier holding company would in fact be an insurance underwriting company under the language of the bill. That's clearly not what's intended by the bill, but it's a result of how the bill is currently drafted. So I would suggest, one, that this should be clarified in the bill's language, but two, that this points to a broader concern with the bill, that by creating a new type of regulatory entity that's subject to less stringent regulation than other types of similarly situated regulatory entities, it inevitably creates the risk of regulatory arbitrage. Second, I want to clarify the statements that have been made that Dodd-Frank somehow radically changed the regulation that insurance savings and loans holding companies face. In fact, while it did transfer supervisory authority to the Fed, it was the case before 2008, well before 2008, that any entity that owned a bank was subject to federal supervision. And the group-level supervisor for entities, including insurance companies, that held depository institutions was the OTS. It's ironic now that this bill seeks to eliminate federal oversight over such entities, given that a big part, probably the primary reason why AIG failed, was OTS's failure to exercise effective group-level oversight. That's why Dodd-Frank transferred supervisory authority over savings and loans holding companies, all savings and loans holding companies, to the Fed in a way that wouldn't result in regulatory arbitrage. Dodd-Frank created a simple and easy rule. If you own a bank, you will be regulated at the federal level, at the holding company level, and there's no choice about who your regulator will be. This bill undermines that. Third, there's a reason why, until this point, for decades, we have always maintained that if you own a bank, if you're a financial conglomerate that owns any FDIC-insured institution, you must be regulated at the holding company level. That's because if you own an FDIC-insured institution, you have a unique privilege, a federal guarantee of your creditors. That creates unique risks to American taxpayers and to the federal government. And a core goal of banking regulation is to manage those risks. Banking regulation accomplishes that by regulating both the bank and the holding company. If you now eliminate federal oversight of any financial conglomerate that owns a bank, you create the risk that we're now not just going to have small FDIC-insured institutions and savings and loans holding companies, but that we're going to expose the insured depository fund to heavy losses that are actually a result of its non-bank affiliates. The final point I want to make is that while it's the case that state insurance oversight is generally strong with respect to the individual entity, the core goal of state insurance regulatory oversight is not group regulation. In fact, insurance group regulation really, for all intents and purposes, didn't even exist until 2008. So the notion that we're relying on some tried and true regulatory system at the insurance level, at the holding company level, is simply false. It is a new regime that has yet to be tested. And I think it's a mistake to eliminate federal oversight on the assumption that it will work well in the next crisis.
The gentleman yields back. A little out of order, but one of the authors of this bill, Ms. Beatty from Ohio, I had a little traffic on the way in, so I want to recognize her for 2 minutes for her opening statement.
Thank you, Mr. Chairman and Ranking Member, but let me first thank you for allowing me this opportunity. And my delayed arrival was because, again, a bipartisan event was being held. Congresswoman Kathy McMorris Rogers joined other leaders as we saluted Leader Pelosi for her gavel and suit going into the Smithsonian this morning. But let me say to our witnesses, thank you for being here, and to my colleague, Mr. Rothfuss, who I had the pleasure to work with on a bipartisan basis to advance this bill through the Congress. It is always a pleasantry to welcome our witnesses, but today I take special honor in having someone here from my district, and thank you, Mr. McAfee, for being here. In my opinion, this bill simply seeks to right-side the excessive burden of regulation placed on insurance savings and loan holding companies compared, and this is really important, compared to the risk they pose to financial stability. None of these companies have ever been designated by the Financial Stability Oversight Council as posing a risk to the financial stability of the United States economy, yet they face similar regulations by the federal government as if they were, all because of the way they're structured. There is no reason, in my opinion, why a smaller insurance company like Ohio-based Westfield Insurance Group should face more regulations than some of the larger insurance companies in the country due to the fact that they have a small depository institution. For me, it just makes no sense. Now, this is a bipartisan bill, and I'm reasonable, so I look forward to hearing from the witnesses on their experiences as insurance savings and loan companies and ways to improve the bill. Thank you, and I yield back.
The gentlelady yields back. The chair now recognizes himself for 5 minutes. I just want to be clear on a couple things. There's been in this committee a lot of debate about Dodd-Frank at different levels, but I don't think anyone says Dodd-Frank is perfect, and I think this is a recognition that there could be some tweaks and modifications to make it work better, and that's why we have a bipartisan bill to look in and make some slight modifications, and I think this is an example of thoughtful bipartisan brainstorming, and I'm sure that both sides are open to good ideas, whether it's from the panel or from other members on the committee, to tweak or modify to make the bill even better. And I would note that the ranking member made a comment about loopholes for big banks. I don't think that's the intent of anybody on this committee, and if there's an issue with that, I think we could all work together to address that concern that the ranking member may have. But I want to be clear on the way this bill works, and maybe to Mr. Bach, with the bank that's under the holding company, is there any entity that would regulate the bank under this bill 5059?
And the bank is regulated by the OCC.
It's regulated by the OCC, right? So it's still going to be regulated, right?
Yes, sir.
We feel like the OCC is a pretty good regulator? OCC
has been a very good regulator.
I would agree. So let's look at the insurance companies that fall underneath the holding company. Are those, would they be unregulated under this structure of this bill?
They remain regulated as they are today by our state insurance department.
By the state regulators. And so have they been pretty effective regulators over the last 150 years?
Been very effective, and I would add that they continue to add to their tool sets and in terms of risk management and being able to look at our own risks. So yes, very effective.
And under this bill, the Fed would still have a role at looking at and regulating the holding company. Is that correct?
Absolutely. The bill continues to provide for that.
And so we have 3 great regulators who are taking a piece of the pie, who know how to regulate, have been successful in the regulation, and regulating different pieces of different businesses or industries. But it's fair to say we're trying to eliminate duplicative regulation. Is that fair to say, Mr. Mahaffey?
Yes, I would concur with that.
Okay. And so if you heard Professor Schwartz's testimony and his concerns about it, and I think he always gives wise and smart testimony. I don't always agree with it, but would you agree with his assessment on the dangers posed by this bill?
Well, I think he raises good points, and I share your comments and your perspective that there is no intention here to create any loophole that would allow for an entity that's unaffected by this to somehow get into this and create a small insurance entity that stands above a big bank. So I think anything that can be explored to tighten that loophole, we would be in support of. That is clearly not the intent of this.
Right.
And I think you said this well. This is not a matter of us seeking to eliminate the role of federal supervision. This is a matter of sequencing and right-sizing it, recognizing what we would consider to be the primary role of the state insurance departments in regulating that insurance entity. So I think you summarized it well. At the bank level, there would be the OCC, who supervises the bank. At the insurance holding company level, that is comprehensive and does now include both legal entity and consolidated responsibilities for supervision. That would fall to the insurance departments. And then the Fed would remain in the ability to monitor, receive information from the insurance departments as well as the insureds, and have the ability to understand whether there are any supervisory gaps within that insurance holding company system and reinsert themselves if those were the cases.
And I want to be clear on one point, because I think this was a smart number, but you guys can tell me if you think I'm wrong. But this is not a new regulatory regime for a bank structure that will buy an insurance company held under the holding company. You have to have 75% of your assets under the holding structure in the insurance business. Is it, Mr. Bach, is that your understanding?
Absolutely. You'd have to buy a lot of insurance companies in order to exceed that threshold.
And I would just, I'll maybe read from page 2. It says a savings and loan holding company that held 75% or more of its total consolidated assets in an insurance underwriting company or insurance underwriting companies. And so I think that part was pretty clear. I only have a couple moments left, and maybe other people would get to this. I do think a point that's usually made is an AIG point in regard to insurance, but I think it's always critical to point out that it was the financial products unit at AIG that created a lot of the issues, as opposed to the entities that we're talking about under this bill. My time has expired. The chairman recognizes the ranking member, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Let me get right to one of the significant points that this hearing must address, I think. And because those who are opposed to this legislation are saying that this is a solution in search of a problem, a hammer in search of a nail, false teeth in search of food. What I need to find out from you is whether you agree with that. Do any of you agree with any of the 3 examples? Show the teeth.
I would probably cast it a different way, as 5059 is something we've been waiting for. We applied for deregistration in 2012, but stopped our deregistration process, awaiting for legislative relief. So, in terms of a hammer looking for a nail, I believe it's the appropriate tool that we need now to right-size regulation and remove the duplication.
Mr. Schwartz.
Thank you. I want to address that issue, but if I may, I just need to turn back to something. It's really one of my more important points, and it goes to questions that Mr. Duffy was raising. Because I don't think, I understand that you characterized the intent of the bill, but I actually don't think you accurately characterized the effect of the bill. So I just want to clarify how it's drafted so that you can redraft it to reflect that intent. Because the way an insurance and savings and loans holding company is defined on page 2 of the bill is any one of 3 circumstances can be met in order for you to qualify as an insurance savings and loans holding company. And you quoted from portion 2 of that definition, which contains a quantitative threshold for your assets. So in order to fall under subpoint 2, you'd have to have 75% of your assets in an insurance holding company. Subpoint 1, though, defines any entity that has a top-tier savings and loans holding company that is an insurance underwriting company as an insurance savings and loans holding company, irrespective of what percentage of its assets are in insurance. The effect of that is, and I know this is not your intent, J.P. Morgan, tomorrow, if you pass this bill, could have its top-tier holding company start issuing insurance fall within insurance savings and loans holding company, and then avoid federal supervision. So this is just an error in the bill that needs to be fixed, in my view. And I really hope that even if you support the spirit of the bill, that you fix this. To get to and I apologize, but I just really needed to make that point. To get to the underlying question, I do believe that there are issues here that are important to address. I believe that federal supervision of insurance savings and loans holding companies should be tailored to the risks that are posed by those entities, and I believe that it shouldn't be duplicative with general oversight that insurance regulators are conducting. But my understanding is that the Fed is very open to that the Fed currently doesn't engage in oversight of the state-licensed insurance entities, and that its oversight is focused at the group level to make sure that broader risk management concerns are being addressed. That's actually not the focus of state insurance regulation. So my view is that right now, if it's, maybe there's a problem, but this is not the solution, at least as it's currently drafted.
Well, thank you. I'm taking the double advocate position here. Well, let me do it in a non, I don't want to attack the devil, but I'm looking for the validity of the legislation, you know, how necessary it is. And I said in my opening statement that I am frustrated about duplicative or pedantic compliance cost, which I think my Republican friends and I we agree on the need to reduce this, but I need to understand as clearly as you can in 20-something seconds how this is hurting your business.
So if I could, I think the easiest proof is in the number of entities that have voluntarily divested or closed their banks in response to Federal Reserve supervision. Most of the entities we're talking about being affected by this bill had thrift operations before the financial crisis. They did not enter them post the financial crisis, but a number of entities have voluntarily decided to exit these businesses because in their judgment, the costs simply outweighed the benefits. You know, Nationwide continues to believe that this provides a valuable product and service offering to our members, but the costs are significant. And despite the best intentions of the federal examiners that are on the ground, there is unavoidable duplication. Our holding company, our top-tier company, is a licensed insurance entity, and so there is unavoidable redundancy in terms of what gets examined, the standards that are applied to those examined. There are over 200 SR letters that are applied to us, most of which have equivalent standards that are different in the state insurance world. So it is a reallocation of significant amounts of resources away from those exams to the Federal Reserve exams. There's a heavy dose of education because by and large, while the Fed has done a lot to come up to speed and staff up, it has required an inordinate amount of investment from the companies that are supervised to continue to work with them on the differences between insurance. And again, I do not fault the federal examiners.
Time is up.
The gentleman's time has expired. That was a very long 20 seconds. But we appreciate the answer. The chair now recognizes the vice chairman of the subcommittee, Mr. Ross, the gentleman from Florida, for 5 minutes.
Thank you, Chairman. And then, Mr. Bach, you've commented in your testimony on the cost and inefficiency of the Federal Reserve supervision. In fact, to follow up on Mr. Cleaver's, the ranking member's questioning, can you cite some examples of regulatory duplication as a result of current law?
So regulatory duplication, the amount of reporting to the Federal Reserve is breathtaking. And they took a number of reports. So we actually provide to our own regulator, to the insurance regulators, so like our own risk self-assessment.
And then you turn around and report it to the OCC,
absolutely,
the Federal Reserve.
Absolutely. So you know, the financial reports, et cetera, everything.
And that inures to your bottom line, no doubt.
Absolutely, absolutely. So we spent an additional, let's say, 25% of our time responding to the same issues that we always respond to our
and this current law is predominantly why Country Trust Bank is no longer in existence, correct?
We're in existence still with trust-only powers. So,
okay.
So we deregistered for trust-only powers specifically to keep serving our customers, but also to reduce the cost, which had no benefit. That was federal oversight.
Mr. Schwartz, I appreciate you raising concerns related to regulatory arbitrage, and I appreciate you being here, and I can assure that I think that we would all agree that the intent here is not to provide a creative way for financial services conglomerates to avoid federal oversight. In fact, I believe the bill provides certain safeguards against this possibility by using a number of mechanisms of which you alluded to. It defines an insurance savings and loan holding company as a savings and loan holding company that holds 75% or more of its total assets in an insurance underwriting company or companies, and it requires 75% threshold to be met in the most recent 4 consecutive quarters. And it has to also have been savings and loan holding company to have been registered before July 21st, 2010. Now these are some pretty significant safeguards. Are you suggesting that these aren't?
Yeah, no, I am suggesting they aren't. You're not, and I'm suggesting you're actually not reading the bill correctly. If you look at page 2, line 23, it's an or.
So you suggest we put an and?
So just like, well, if you put an and, that would definitely...
That would resolve it.
That would resolve it. I think it would create other problems because actually several of these companies would no longer be
But really, what other problems would it create? I mean, it's not a less regulatory scheme, as you say.
Oh, no, it absolutely is.
On whose part?
Well, I don't understand. If you're saying it's
I don't understand either, because you see there's 2 regulators there.
Right, wait.
Well, there's 3 in the Fed and there's 1 in the state.
Yeah, no, but let me try to answer. Just
please do.
Yeah, okay, great, thanks. So just let me be very clear. The definition of an insurance savings and loan holding company under the bill allows you to qualify if you meet any one of 3 criteria.
Which are fairly stringent. Which would also prevent...
No. The criteria...
We're going to go back in time to July 21st, 2010?
Criteria that you own, that your top-tier savings and loans holding company is an insurance underwriting company, can be satisfied if you take your top-tier company and you get licensed in 1 state to sell any insurance, you qualify.
And that causes less stringent regulation?
Of course. If
to whom? What about the state regulator? Are you demeaning the state regulator by saying they don't require stringent regulation?
Let me answer.
I don't think you do. I think what we're doing is we're allowing the consumers to have the benefit of what has been probably the most efficient, effective, and cost-effective regulatory environment out there, and that's the state.
I think it's
Your testimony is incorrect. It doesn't require this law to come into effect to allow for less stringent regulation. Just the opposite.
I think it's really funny that you're saying there's not stringent regulation, but they're all...
No, you said it wasn't stringent regulation. You said this bill will lead to less stringent regulation, and I take issue to that.
Because the Fed
in the academic world, yes, but maybe not in the real world.
The Fed is not regulating you at the holding company level unless certain...
But you're going to regulate them at the state level.
Yes, that's less stringent
and that
regulation.
Is not state level is less stringent? Okay. The best consumer protections we have out there in any type of regulatory environment in this world, and you're saying it's less stringent? The most significant that's closer to the consumer, you're saying is less stringent?
Can I answer, or are you just going to talk to me?
Saying less stringent?
No, well, I'll answer if you want.
I think you already have answered.
Well, I don't...
Go ahead.
Okay, sure. It's less stringent, yes. That's precisely why there's less cost if you, in fact, avoid the regulation.
And less cost is bad?
No, it's good, but it also relates to there being less regulation. I mean, I don't understand how you can simultaneously say we're reducing the regulatory burden, but we're not reducing regulation. The two go hand in hand.
You already have duplicative regulatory burden that has been in existence since Dodd-Frank. We're trying to remedy that, and that's what this does, and still allows for stringent regulation on behalf of the states.
Whether or not it's appropriate, we can debate about that. It does reduce the amount of regulation. Okay?
It may reduce duplicative, and that's a bad thing. That in and of itself is indicative of why we have a difference
It's
here.
a bad thing.
I think we need less regulation when it burdens the consumers.
Okay. The gentleman's time has expired. The chair now recognizes the co-author of this bill, the gentlelady from Ohio, Ms. Beatty, for 5 minutes.
Thank you so much, Mr. Chairman and Ranking Member. I have a series of questions, so I'm going to ask you for shorter answers. But first, Mr. Chairman and Ranking Member, I would like to enter this statement for the record. It is a letter from the American Life Council of Life Insurers supporting this bill.
Without objection.
Again, let me thank all of the witnesses here and say how much respect I have for all 3 of you. And at any time in my career that I've read something from all three of you, here's a good answer. I've agreed with all of you on some things. So we'll take it down a little notch here. And first, let me say to you, Professor Swartz, that I appreciate your comments. And you would be happy to know that we are already in some discussions about making some changes, which are no doubt important. But after hearing Mr. Bach's story about Country Financial, Professor Swartz, do you believe that spending 25% of a company's compliance cost on a subsidiary that accounts for only 0.2% of a company's total assets is excessive and burdensome? And a quick answer.
Yeah, it may well be. I do think that there's a very important goal here of reducing regulatory costs. I just think we need to do so appropriately.
Okay, so let me say to all three of you that we have three members from the great state of Ohio here, so to my good friends from Nationwide, I know I speak on behalf of my other two colleagues, and you may later tell my two Republicans that I spoke for them today. In thanking you, but also beyond this, I want to thank you for running an outstanding business and that you've been a true partner to the community to help Columbus and Central Ohio to keep us moving forward. Mr. Mahaffey, this question is for you. Nationwide is subject to group-wide supervision by the Ohio Department of Insurance. Is that correct?
That is correct.
In addition to being regulated by the state of Ohio, are you not also subject to financial condition supervision and regulation in Arizona, California, Iowa, Michigan, New Jersey, New York, Texas, as well as subject to insurance regulations in all 50 states and the District of Columbia?
Yes.
And on the federal level, are you regulated by FINRA, the OCC, SEC, Department of Labor, IRS, and subject to group-wide supervision by the Federal Reserve?
Yes, that is also correct.
Seems like a lot of regulations to me. Are you aware of any other class of financial institutions that have dual holding company supervision by the Federal Reserve and another prudential regulator?
No, not in the U.S.
Are insurance savings and loan holding companies regulated on a group-wide basis by two regulators because they are the biggest and most complex insurance company if they were to fail that would bring down the U.S. economy?
No.
And who has had more experience and more expertise in regulating insurance companies such as Nationwide, the Ohio Department of Insurance, or the Federal Reserve?
Clearly the State Departments.
If this bill were to become law, would you still be regulated by the Ohio Department of Insurance and all other states you do business in?
Yes.
Your depository institution would still be regulated by OCC, is that correct?
That is correct.
And you would still have to comply with the Federal Reserve's insurance capital requirement, submit various reports to them, and be subject to direct supervision if the Federal Reserve believed that your company was in material distress. Is that correct?
That's correct, and I would include in those capital standards prospective stress testing as another requirement.
Okay. Can you explain the benefits of Nationwide's depository institution provides to your business, your customers, and why you have made a decision to not get rid of it?
Sure, and being as brief as possible, one benefit we have as a mutual insurance organization is the benefit of diversification of our risk portfolio. That is the benefit of anybody buying insurance, is diversified risk. The bank gives us another business with uncorrelated risks to the rest of our business. More directly to our members, to those people we exist to serve, it provides additional products and services that we can uniquely tailor to their needs that work in concert with the other products and services we offer. The examples I gave in my testimony of prepaid claims cards and emergency debit cards for folks in the wake of natural catastrophes are perfect examples of that.
And lastly, do you not believe that the state-based insurance system that has governed this country's insurance system for almost 150 years is effective and time-tested?
Yes.
Thank you, Mr. Chairman, and I yield back.
The gentlelady yields back. The chair now recognizes another author of this bill, the gentleman from Pennsylvania, Mr. Rothfuss, for 5 minutes.
Thank you, Chairman. And again, I want to thank my colleague, Ms. Beatty, for her work on this legislation. She introduced a letter from the ACLI. I'd like to offer for the record letters of support from the Property Casualty Insurers Association of America, as well as the National Association of Mutual Insurance Companies. For the record. Mr. Chairman? Okay, I wanted to offer for the record a couple of letters of support, one from the Property Casualties of Insurers Association of America and the National Association of Mutual Insurance Companies.
Without objection.
I want to talk a little bit about this. The ranking member raised this issue. Is this a solution in search of a problem? So if I can go to you, Mr. Mahaffey. Again, we've heard from Mr. Bach about their compliance costs. Can you elaborate on how Fed supervision has affected compliance costs and Nationwide's business of operations and compliance costs?
Yes.
Can we quantify it?
We have similar experiences. I mean, it's a reallocation of finite resources. And to be clear, we have added resources to comply with those Fed standards and regulations and examinations. I think the estimate of 25 to 30% of, for example, my team's time in enterprise risk or in the compliance function as an example, being reallocated to these is a reasonable estimate. But I would also argue that those costs that are very difficult to quantify go well beyond just those dedicated teams that have direct responsibility for the relationship in conducting of exams. It is a prominent focus all the way from the board through senior management to direct frontline associates, given the extensive nature of the supervision and the ongoing presence of examination. So the costs are material, and there are specific examples where we have had to incur very specific costs to stand up programs that comply with Federal Reserve expectations.
Can you tell us, what aspects of Fed supervision are inappropriate for an insurance company?
I would start by sort of highlighting the differences in the nature of their supervisory frameworks that they bring to bear. As we've all said in our testimony, they come with a banking developed toolkit. So the very the basis from which they engage in supervision.
Notwithstanding that, they were supposed to be getting some expertise in insurance, you still find this to be a problem?
And I would say we do still find it to be a problem, and I will still give them credit for working with us, for example, on the Capital Standards Clarification Act and the capital standards in the wake of that. We found them to be very willing partners, but you're talking about an immense body of knowledge that's been developed over decades exclusively with the banking arena, and porting that over into an insurance world has inherent inefficiencies. And when you apply that at the group level, redundancy and duplication is unavoidable.
Mr. Bach, we've heard from Mr. Mahaffey about how Nationwide has used its S&L. Can you elaborate on what role the former S&L played for country?
Well, it's still, it's still our trust bank. It houses our wealth management business, so it still exists. It was a grandfathered unitary savings and loan holding company that was under OTS from Graham Leach Bliley. But we wish to hold ourselves with that status through conversion into being regulated by the Federal Reserve, but found, as we have said, the costs were way too high for the benefit that it was providing to our policyholders.
What kind of consumer impacts would you see as a result of this action for your customers?
This action that we took?
Yes.
It obviously reduced our costs. We now spend our time focused on those risks and those things that are most beneficial to our policyholders, and it allows us to let our regulators play the role they should play. The state regulators regulating us, OCC, et cetera.
Mr. Mahaffey, is Fed supervision as it is currently conducted necessary to protect against systemic risk, or is it possible to achieve the same goal more efficiently with respect to Nationwide? We
definitely think it's possible to achieve the same goal more efficiently. And you mentioned systemic risk. I will note that the Fed has said publicly on many occasions that these ISLHCs that we're talking about do not pose systemic risks. And this bill does not touch the authority of the FSOC to designate anybody who would pose a future systemic risk to come back into Federal Reserve supervision. So as it is currently conducted, there are definitely opportunities. We think this bill addresses that opportunity.
In working on this legislation, I wanted to ensure that this bill solves the problem we have identified while guaranteeing that vital information gets to the appropriate regulator. Again, this is about right regulating, not deregulating. Mr. Mahaffey, can you please talk a bit about how this bill would change which reports you provide to which regulators and why that deconfliction is important?
Yes. So the way I would describe this is this would respect the primacy of the Department of Insurance in the state of Ohio as the primary day-to-day supervisor and examiner of Nationwide. The Federal Reserve would have access through the State Department of Insurance for all of the information that they would garner from Nationwide, in the same way that all of the other states that play a supervisory role for Nationwide participate and cooperate with Ohio for that information. It would also provide them with direct access to a lot of individual information on financial reporting, holding company structure, legal entity structure, business structure, and all of the necessary requirements for their capital standards. So they would have direct access for the important information necessary to monitor that system. We think that that construct provides a ton of efficiency for Nationwide by removing that sort of day-to-day duplicative examination burden that really requires that inordinate amount of time that I described and Mr. Bach described.
Thank you. My time has expired.
Gentleman's time has expired. The chair now recognizes the gentle lady from New York, Ms. Velazquez, for 5 minutes.
Thank you, Mr. Chairman. Mr. Bach, there are currently 12 insurance savings and loans holding companies that fall under federal supervision due to the fact that they own a depository institution. Can you give us a description of these companies? What business are they in? What type of products do they offer? What is their risk profile?
I can, thank you. I can give you just a quick thought as they range from companies that are very multidimensional, like Nationwide, that serve a broad range of customers, all the way down to companies such as Westfield, which serves a regional market, same thing, its customers. And so the banks are there for focusing on customer products and diversification, as Mr. Mahaffey said. So in terms of their risk, it's absolutely limited because of the current supervisory structures that they had prior to Dodd-Frank.
Okay, so what does owning a thrift allow these companies to do that they otherwise wouldn't be able?
In today's world, obviously financial security is important for every home, every customer, and it allows insurance companies to focus on the needs of protection as well as preservation of assets. And so it serves a broader range of protection, but also protection for great retirements, et cetera. So that's my personal view.
Thank you. Mr. Mahaffey, same question to you. What does owning a thrift allow Nationwide to do that otherwise would not be able to?
So the purpose of our thrift institution is not to create a large independent bank that serves non-member customers for Nationwide. It's quite the opposite. Our owning of a thrift is designed to create products and services that augment our existing insurance and financial services products in ways that we think create convenience and other sources of value for our members, like those post-catastrophe claims cards and debit cards, things that would be very difficult to execute if we were doing with it a third-party partnership because they would have a different interest in how they serve our members.
Professor, would you care to comment on?
Yeah, so I think that it varies, and I think that in certain contexts, like Nationwide, the bank may be very small. For other insurance savings and loans holding companies, the bank actually can be a substantial portion of the company. So just for instance, USAA, I think their bank has $80 billion in assets. TIAA just acquired EverBank, which I think had many, many billions of dollars in assets and do operate as freestanding banks. The other point I would just make is banks, they allow you to serve your customers in unique ways. They also do create unique risks, and that's because they're federally insured. They're unique in that respect. And that's why banking regulation is different than other types of regulation. And it's also why it has to occur both at the level of the individual bank and at the holding company level. If you only have bank regulation at the individual level of the bank, then there's a substantial risk that that bank can actually be either exploited by its non-bank affiliates or can actually be destabilized by those entities.
Thank you. Mr. Mahaffey, I am very concerned about bifurcated regulation, and I am concerned about the regulatory regime this bill creates. I was here in 2008 and witnessed the near collapse of AIG and how it and other firms like it nearly destroyed the financial system and world economy. Please tell me how H.R. 5059 both relieve the duplicative regulation that you spoke to and yet guarantee the public that we are not ushering in another AIG.
Thank you for the question. I think it's important to note that this does not remove the role of federal supervision from the group level. It simply delineates it from the role of the state, and in my opinion, sequences it so that it has a complementary role, not a redundant role. So what we're seeking to do, and I think Chairman Duffy described it very well, as it related to our bank, we have an OCC dedicated regulator that would be full-time. We have a group consolidated supervisor at the state level, and the Fed would still remain responsible for the holding company with review authority for all of the information and ensuring the completeness of coverage of regulators within the holdco with the ability to step back in if we fail certain tests like the capital standards.
Professor, your take on this question?
So first, I agree that a very important element of this bill is that it doesn't restrict FSOC's ability to designate firms like AIG as systemic. So I do think that that's an important point, and one reason why it's not as dangerous a bill as it very much otherwise could be. I think that, so I don't think we're talking about systemic risk concerns. I think what we're talking about instead is the concern that American taxpayers will end up having to incur the costs associated with bailing out a bank that failed because of its non-bank affiliates. And,
Thank you.
Yeah.
Thank you, Mr. Chairman. You're back.
Gentlelady's time has expired. The chair now recognizes the gentleman from Missouri, the chair of the Subcommittee on Financial Institutions, Mr. Luke DeMeyer, for 5 minutes.
Thank you, Mr. Chairman, and welcome to our guests. I want to thank Mr. Rothfuss for his common sense legislation here that I think Mr. Mahaffey just really did a good job of summarizing what we're trying to do here is not to deregulate, but to find a way to not have this extra layer of regulation there that causes costs and confusion. So I appreciate your comment. Also, I appreciate Professor Schwartz's comment a minute ago with regards to tailoring regulations to risk. I think that's extremely important. I think we're trying to do that as a committee on a whole lot of levels to try and find ways to make sure that the regulations are not there to be more punitive than necessary, to continue to allow the freedom of businesses to do their job, at the same time making sure there is a box within they operate. And you have to tailor the regulations to make sure that you protect that box. And I appreciate that comment from the professor. Mr. Mahaffey, you've been very articulate with regards to how your company is working through this. I just want to have one more question for you with regards to the relationship with the Federal Reserve and your ability to do your job. If the Federal Reserve is overly cumbersome, how does it really affect your business to assess and do your job with regards to insurance risk?
To the extent we are allocating scarce time and energy amongst my staff or other risk-related staff within the organization, if we are doing so in a duplicative manner, that probably naturally results in less time for other material risks that could otherwise use that time. And I would point to the fact that because there are inherent differences in the risk profile of insurance entities versus banking entities, that by and large has meant we are pulling time away from what I would consider to be potentially more material risks on the insurance side, natural catastrophes, mortality, morbidity. These are not risks that exist in a banking construct. So all of our time and energy is spent competing for where we allocate that time to manage these risks. This would reduce duplication and allow us, I think, to be more efficient in the allocation of risk management time, which by and way coincides with the ability to protect policyholders and depositors.
I think, Mr. Bach, a while ago you mentioned something about the regulators using bank standards to regulate insurance companies. I believe you made a comment to that effect. I'm sure you didn't mean that, but I'm kind of curious as to what was going on with that comment because it raised some antenna here.
Yeah, thank you. Our experience was that the standards they use, the SR that Mr. Mahaffey referred to, were the same ones that came from the banking experiences. So yes, it was. We were hoping for tailored or appropriate.
So they really were using really inaccurate standards in your judgment, because you have two separate business models here. Banks and insurance companies have two completely different business models. It's really need to have two separate tailored rules for those folks, and yet the regulators were using more of a bank standard to analyze the insurance part of this. Is that what you're saying?
I would say not. So not necessarily bank capital standard, but they were using their SRs, their bank checklist, to go through things like cybersecurity risk, enterprise risk, et cetera. So they were not tailored to us as an insurer to our size as a.
Okay, you're using the word "were." Have they changed this now? Are they doing a better job?
We left federal supervision in
Okay.
2017.
Okay. You had a buzzword there that's important to me. We're going to have a data security, cybersecurity hearing this afternoon, and I've got a bill that we're working on to try and address some issues there with data security. And so one of the questions that's going to come up this afternoon is the duplicative nature of all of the different rules and regulations with regards to data security, cybersecurity, notification across the country. You got, 50 states, and you got anywhere from 40 to 50 different standards on things. Do you see there's some duplicative problems here with the way cyber is looked at with Fed and state examiners?
There is some duplication. I would say that the state insurance departments, the NAIC, are looking to coordinate to ensure we have a common and a very thoughtful.
Do they work collaborative on this?
Excuse me?
Do they work together on this to make sure that there's no overlapping problem?
I say that it's emerging right now because the New York Department of Financial Services has been very vocal about how to improve cybersecurity, how to improve cybersecurity reporting.
I don't have much time left, so I'll be very brief here. I think, Mr. Mahaffey, you made a great comment a minute ago with regards to the OCC is one regulator, the state's one regulator, and the Fed regulates your holding company. I'm not sure some people understand the relationship between the bank that you have, the insurance company you have, and the holding company. Could you just use a few minutes here with the indulgence of the chairman to kind of give that relationship to understand, so people understand why it's there and what the purpose of it is and how it's regulated?
Sure. So in our case, our top-tier holding company is a licensed insurance operating company, which means everything underneath that holding company is subject to state supervision. One of the entities within that.
So the holding company actually owns both entities, and then the Fed is examining that entity. Is that correct?
The state and the Fed examine the holding company, which includes all of Nationwide subsidiary entities, and that holding company is a licensed insurance entity as well.
Okay, thank you very much. Appreciate your indulgence, Mr. Chairman.
The gentleman's time has expired. The chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Mr. Bach, in your oral testimony, you spoke positively about state regulation. Perhaps you could drill down into the specifics and help the committee better understand what processes state regulators use to ensure that consumers are protected.
Thank you. The state regulators maintain a continuous discussion with us every day. They have the gold standard in financial reporting. The development over the last 5 years of own risk self-assessment, enterprise risk management tools, et cetera, reports to them really safeguard the customer. So what I would say is their regulation and oversight is continuous. They know us. They know us for the last 92 years.
Thank you. Professor Schwartz, we got to protect the depository institution in large part because it's federally insured. The management and directors of such an institution could make a number of mistakes in making bad loans. They could pay dividends and stock buybacks to deplete their capital. So if we're looking at the entity itself, the banking entity, why should we be more concerned if its ownership is affiliated with an insurance company than we should be about the entity itself if it isn't affiliated with an insurance company, but its board of directors may just not want to keep too much capital around?
So it's actually been a principle of banking regulation for 70 years, I would say, that we have to regulate both the entity and the holding companies. The Bank Holding Company Act established that in the 1950s, and it's been the case for savings and loans holding companies too, before Dodd-Frank. I think that's a really important point. Before Dodd-Frank, savings and loans holding companies were regulated at the holding company level. The reason is because failures of the non-bank affiliates can end up affecting the bank. It can end up being the case that you get preferential loans to the non-bank holding company. It can end up being the case that there's no capital to be made. In other words, it can end up being a source of weakness, and we saw this with AIG. AIG's insurance companies were endangered by the fact that we had other entities that were not insurance entities that were in jeopardy. The same
Well,
thing
the big problem there is, and we've talked about this, is that we allowed the AIG's unregulated entity to sell credit default swaps, which at least I believe to be portfolio insurance.
Right. I would just not forget about the securities lending operations as well, which were under the supervision of the insurance regulators. So there were issues at multiple levels with AIG.
Okay. To what extent can Professor Schwartz, can the Federal Reserve further tailor its supervision of insurance savings and loan holding companies in a responsible manner? What can we do? I know you don't want to go as far as the legislation before us. What can we do to limit the regulatory
No, I think
burden?
that's a really important question, and I guess that's where I would focus if I were you. That's where I would focus the inquiry. I'd ask that question, how do we change it? I think the answer is you have less stringent supervision depending upon the size of your bank and depending upon the complexity of your organization. My concern is that this bill doesn't tailor because it actually cuts off the Fed's authority to regulate at the holding company level unless one of several sort of clear triggers are hit. There's a capital deficiency or there's a determination that it's a material financial distress. And so my concern is that actually rather than tailoring, you're actually going in the opposite direction of cutting off the Fed's ability to tailor. I have no qualms with the idea that perhaps the Fed, I don't know, the Fed may need to better tailor its supervision.
I want to hear from Mr. Bach on that same issue.
I think the bill does a very thoughtful way of still retaining the Federal Reserve's ability to step in to take action, so it doesn't diminish the Fed's ability in any sense of at least the language in the bill.
I'll yield back.
The gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Holgren, for 5 minutes.
Thank you all for being here. We appreciate your testimony and your work. I'm going to address first questions to Colonel Bach, if I could. Again, thank you for your service. Also, I know out of the 5,000 plus employees that you have, 3,600 I think are in Illinois, so we're grateful for that, the big impact on our state and tons of customers as well, so grateful for that. I did want to just talked about this, but I wanted to go into a little bit more specifics. In your testimony, you noted that Country Financial maintained a savings and loan holding company up until recently, and then you made the decision to deregister it because the regulatory burden greatly outweighed the value to the company and your policyholders. I wonder if you can think of any other example in insurance or banking regulation where something that's 0.2% of your overall assets accounts for 25% of the hold company's total compliance staff resources. It seems obvious to me that Congress needs to revisit this duplicative regulation, but wondered if you could talk maybe a little bit more about that.
Yes, thank you. Obviously, we kept registered, awaiting for regulatory relief, and we've been told that your supervision by the Federal Reserve is just your price of admission. But quite frankly, we were already at the movie. And the admission costs went up. We sat and reviewed, just like Mr. Mahaffey did. We're spending an inordinate amount of time on something that was adding no value to our policyholders, and so really, for the benefit of our policyholders, it was not a decision we wanted to make, we had to make.
Mm-hmm. I wonder if you could talk a little bit about the strength of state regulation. Can you be more specific about how state regulators supervise a company like yours, and why is this regulation as good or better than federal regulation could be?
Well, I think this one gives a clear and thoughtful way of a division of responsibility, division of labor. Our state regulators obviously get our financial reports consistently. They have the ability and a number of tools to be able to intervene and to question and to ask. We also, at this point in time, are going through our 5-year financial exam, and that is an exam that lasts for at least a year or a year and a half. So there is nothing that our state regulators don't know about how we conduct business, and they have market conduct evaluations, et cetera. So they have a huge tool bank with which to regulate us and which to interact with us.
I know you've talked about this briefly, but I wonder if you can maybe go in just a little bit more detail of explaining why a change in law is necessary in order to have a state-based regulation as the primary approach.
Well, obviously we're strong supporters of McCarran-Ferguson because the state-based approach has consistently, continuously worked When the Federal Reserve came to us, when we talk about regulation, it was duplication in a massive extent, and with no benefits. So as I take a look at this legislation, it actually does thoughtfully give a division of labor. It also has some safeguards, but it certainly doesn't allow someone. I can't imagine someone like J.P. Morgan Chase trying to become an insurance company and having the Federal Reserve Board allow that, or having a bank buy an insurance company and the capital requirements, or have an insurance company buy a bank and the capital requirements that it's required. So some of the things that sound like gaps are not gaps. They have absolutely been filled by our current regulatory scheme.
That's helpful. Thank you. Mr. Mahaffey, I've just got a minute and a half or so left. The number of companies that would be considered insurance savings and loan holding companies under this bill has decreased significantly since the enactment of Dodd-Frank, as firms have eliminated their thrift subsidiaries. Why would an insurance company maintain a thrift subsidiary, and how has maintaining a thrift benefited Nationwide and its policyholders?
Well, again, we like Mr. Bach, have been hopeful for regulatory relief and fixes, and we would again applaud the Fed for their ability within the confines of the current construct, the current regulatory regime, to be flexible where they can. But we do think that this bill goes further and actually changes the very construct in which both the state and the Fed needs to operate to align them better. Without this, it does raise questions amongst most of those institutions about whether the cost justify the benefits to the holding company. In Nationwide's case, we've continued to own and operate our bank precisely because we continue to see the potential for massive benefit to our policyholders to continue to offer these products and services.
Thanks. In just the last few seconds, wonder if you could talk a little bit about how this bill, H.R. 5059, reduces compliance cost for Nationwide.
It would dramatically reduce compliance costs, and I would say allow us to redirect our resources to what we would consider to be the more material risk profile of an insurance organization, because it would sequence, and it wouldn't eliminate the role of the Fed, but it would keep them in a monitoring mode to ensure sufficient coverage by the state regulators and other regulators within the holding company, and only to step in and subject us to examinations and the bevy of SR letters we've referred to in the event we failed capital standards, stress test, or there's an entity within our holdco that's not functionally supervised. So it would be exception-based.
Thank you very much. My time's up. I yield back.
The gentleman yields back. The chair now recognizes the gentleman from New Jersey, Mr. MacArthur, for 5 minutes.
Well, thank you. Good morning, and thanks for being here. Mr. Mahaffey and Mr. Bach, if your thrift had gotten into trouble and you needed to move assets to help it, would you be able to do that from your insurance company holdings without approval from state regulators?
No.
No, and I would simply add the caveat, however, that as a mutual insurance organization, we target having sufficient levels of capital, very, very conservative levels of capital by most measures, because all of our entities within our organization share the same brand. And so it would be in our consolidated interest to make sure that all of our entities, including the holding company, have sufficient capital to weather all of those sources of risk within the hold company.
So it would be fair to say then that there would be no material risk to your policyholders because of problems at the thrift?
Speaking for Nationwide, you know, an entity, the Nationwide Bank has roughly $7 billion in assets and is part of a holding company with $230 billion in assets. So I would suggest to you that the risk posed within our depository relative to our overall holding companies is de minimis.
I would say the same. Our life insurance company owns the bank. The life insurance company has $1.2 billion of surplus. Our bank assets are about $25 million. So in terms of material risk to the life company, no. And I would also add that the state insurance regulators review carefully ownership of affiliates.
Sure. I'll come back to the exceptions with Professor Schwartz, because you've mentioned them, but it makes me feel like if I have this glass of water and I put a drop of lemonade in it, or a drop of lemon juice, I haven't turned it into lemonade. It's still a glass of water. And an insurance company that has a thrift, it doesn't turn it into a bank. It's still what it was. It just has a thrift. Professor Schwartz, you sort of implied in your opening statement that a company, a bank, if it wanted to avoid federal oversight, could simply declare itself an insurance company and kind of skirt the rules. Are you aware of any state that allows an insurance company to be formed without achieving certain capital requirements?
No, every state, you have to be licensed and you have to meet certain capital requirements. But under the bill, if you could convince one state to license your top-tier affiliate, and you could put capital in there, then you would actually be not subject to routine federal oversight. So that's the issue.
Well, you would be not subject to oversight in one construct, but you still would be subject to bank oversight from the OCC and insurance oversight from insurance regulators.
But you'd be able to escape bank holding company regulation, which is essential for large banks.
Well, so and you didn't say this, but I think I inferred it from your comments that you're concerned that insurance regulators might not have the capacity and the expertise to regulate a bank holding company or a company engaged in banking. Is that fair?
Well, that's fair. And then also, just an important related point, it's federal funds that are on the line with the bank because they're federally insured. So if you have a federally insured institution, you want federal regulation to match that source of liability.
Can you tell me what percentage of federally insured bank assets have actually been put at risk in any given year?
Well, I mean, that question needs to be unpacked. It depends a lot on what you
I
define
get it,
by...
but you're kind of wanting the tail to wag the dog, it seems to me. But let me just ask this: if insurance regulators are not really the best regulator for banks, what makes you think that the Fed is the best regulator for an insurance company?
Oh, no, I certainly don't. And to be clear, current regime doesn't envision, and my understanding is that the Fed doesn't actually go and supervise the insurance companies. That's not what the Fed is doing. What the Fed is doing is supervising the holding company and at a group level. So they're not actually, there's not
just one follow-up on that. You have mentioned AIG as an example numerous times. If this bill had been law in 2007, well, that's not fair. If this had been law and SIFI designations were also in place, so that would be after 2007, would AIG be able to skirt, or any company be able to skirt?
Well, it depends a lot on whether or not they were appropriately designated as a SIFI, which of course is itself an authority that's not being exercised. But absolutely, there'd be a concern about that. And I would just point out again, because I do think it's really important, even before 2008, savings and loans holding companies that were predominantly engaged in insurance had a federal umbrella regulator. This isn't just going back to 2008. This is changing the regime that's been in place for decades and decades.
I have to yield back, but I would just end by saying there is still regulation of the bank operation here through the OCC. Your belt and suspenders approach comes at a cost to customers, a cost to shareholders, and that's what we have to weigh. It comes at a real cost. I yield back.
The gentleman yields back. I want to thank our witnesses for their testimony today. I think it was insightful, thoughtful, and you've all given us some more information to think about, which is the purpose of an evidentiary hearing like this. So we appreciate your testimony and insight. Without objection, all members will have 5 legislative days within which to submit additional written questions to the chair, which will be forwarded to the witnesses. I'd ask the witnesses to please respond to those questions as promptly as possible. Without objection, this hearing is now adjourned.